Welcome back to the Deep Dive. Today, we're taking a scalpel to one of the most important, yet least understood, institutions in global finance.
The Bank of New York Mellon, or BNY.
Exactly. We are analyzing their fourth quarter and full year 2025 earnings report.
And it's really important for you to understand right up front that BNY is not like a retail bank.
Right, no branches on every corner.
None at all. I mean, their lineage goes all the way back to Alexander Hamilton, and today they are the world's largest custodian.
You've called them the central nervous system for global capital flows.
That's what they are. Think of them as the essential plumbing. They safeguard assets. They clear trillions of dollars in trades every single day for the biggest players in the world.
And our mission for this deep dive is to really resolve a central paradox that's buried in this massive report.
It is a paradox because BNY delivered a truly record-breaking year for 2025.
The numbers are huge. $5.3 billion in net income on over $20 billion in revenue. It's the culmination of CEO Robin Vince's 3-year transformation plan.
And by all measures, a stunning success. Yet, on the day the earnings dropped, the stock price saw this tepid dip.
Down 1.36%.
It's a classic sell the news event. So we need to unpack exactly why the market decided to, punish a seemingly perfect report.
Okay, let's start with the headline numbers then. Because if you just look at the quantitative results, this was a decisive double beat.
Absolutely. They sailed past Wall Street expectations on both the top and bottom lines.
So on the bottom line, earnings per share, what did we see?
Huge leverage. Their GAAP diluted EPS was $2.02. That's a 31% increase year over year, a huge jump.
Now, we often see GAAP numbers get complicated by, one-time charges or benefits. The adjusted figure is what the market really keys in on.
And in this case, it was even stronger. The adjusted EPS came in at $2.08.
So why the difference? What was adjusted out?
Well, they stripped out about $98 million in severance costs, workforce optimization, but they also netted a $50 million benefit from an FDIC special assessment adjustment. So at the end of the day, that $2.08 number is the clean reflection of the bank's core operational power.
And how did that stack up against what Wall Street was expecting?
It blew past it. The consensus estimate was sitting around $1.97 to $1.99.
So that's a pretty significant beat.
For a massive, stable institution like this, a positive earnings surprise of, say, 4.5% to 5.6% is statistically significant. Normally, you'd expect applause. And
the top line, the revenue.
Also robust. Total revenue for the quarter hit $5.18 billion. That beat the consensus, which was in the $5.12 to $5.15 billion range.
And you mentioned the quality of the earnings was high.
This is the really interesting part. The strength wasn't from some, volatile trading win. It was broad-based across their two core recurring revenue streams.
We're talking about fee revenue first. That's the steady kind of annuity-like income.
Right, from their custody and servicing businesses. That grew 5% year over year to $3.7 billion. That's the bedrock.
And the other piece is net interest income, NIA.
And that surged 13% to $1.35 billion. The whole bear case against BNY all year was that NII would collapse as the Fed paused.
Because clients would move their cash to get better yield.
Exactly. But BNY completely defied those fears.
So we have a clear, high-quality double beat.
Yeah.
But the market just shrugged. Which brings us back to the paradox.
Why the dip?
If the execution was so flawless, why the dip?
The problem was one of, I'd say, valuation saturation. It wasn't an execution failure. You have to connect it to the bigger picture.
The run-up in the stock price beforehand.
Precisely. In the 12 months leading up to this, BNY's stock had appreciated roughly 58%. It smoked the broader financial sector.
So the market had already priced in perfection, and a solid beat just isn't perfection.
That's it, exactly. When a stock runs that far, the market requires a massive beat and a raise to justify pushing it even higher. They got the beat, but they didn't really get the raise they wanted.
And that's your second factor.
Right.
The guidance for 2026.
Right. The market looks forward, not backward.
So what did management project that caused this hesitation?
They guided for 2026 revenue growth of around 5%.
Which sounds pretty solid.
It is fundamentally sound, yes. But, and this is critical, it's a deceleration from the 7% to 8% growth they just delivered in 2025.
Ah.
And when that pace of growth slows, even if it's still good, Short-term momentum traders see that as their signal to exit and take profits.
And there was a third factor, something about the expense outlook.
Yes, and this is key for future margins. They guided for expense growth of 3% to 4% for 2026.
Okay, so revenue growing at 5%, costs growing at 3-4%. That's still positive.
It is. It implies positive operating leverage. But that spread, which analysts call the jaws, is much, much narrower than what they just delivered.
I see.
Investors basically read that as management saying, the easy cost savings from the big transformation are now behind us.
Okay, so if that's the forward-looking skepticism, let's look at the flip side. The most impressive part of the actual 2025 results was that engine of profitability, the jaws effect.
This is the defining feature of the whole transformation. Positive operating leverage is just when your revenue line is rising faster than your expense line.
Like a factory making 7% more product, but only spending 2% more on costs.
Perfect analogy. And the numbers they hit are just staggering. For the full year 2025, BNY delivered 411 basis points of positive operating leverage.
411. That is a massive spread.
It's what drove that huge margin expansion. I mean, look at Q4. 7% revenue growth versus non-interest expense that was basically flat year over year.
And the consequence of that discipline shows up in the margins.
It does. The adjusted pre-tax operating margin surged to 37% in Q4.
Up from 30% just a year ago.
So of every dollar that comes in, 37 cents are now turning into pre-tax profit. That's huge efficiency.
And what about the key metric for any bank, return on tangible common equity, ROTCE?
This is critical, because it tells you how effectively they're using shareholder capital.
So what did they hit?
They hit 26.6% in the fourth quarter and 26.1% for the full year. To put that in perspective, anything over 20% is considered excellent. 26% is truly best-in-class performance. It puts them in the absolute upper echelon of global financials.
Which raises the question.
Yeah.
How did they do that with net interest income? How did they defy those skeptics?
That comes down to the structural management of their balance sheet. That 13% NII growth was driven by, and this is the key phrase, reinvesting maturing investment securities at higher yields.
Can you break that down? What does that mean in simple terms?
Sure, it just means they're cycling their assets perfectly. Imagine BNY bought a bunch of low-yield bonds, say at 1% 5 years ago.
Okay.
Now, those bonds are maturing, so the bank gets its cash back. They take that cash and reinvest it today into new assets yielding 5% or 6%.
I see. So they're repricing their asset base at today's higher rates.
Exactly. It structurally expands their profitability, even if the Fed isn't hiking rates anymore.
What?
Their net interest margin expanded by 6 basis points. It's a huge structural tailwind.
Now let's dive into the individual business segments, because this is where you see a real split in performance.
A stark divergence, yeah, between the custodial utility side and the asset management arm. This is a critical distinction for you to understand as an investor.
So let's start with the behemoth, security services, the core utility.
Right. Revenue up a healthy 7%, but the pre-tax income soared 30%.
That's that positive leverage at work.
That's it. And the scale here is just breathtaking. Assets under custody and or administration, or AUCA,
Hit a new record.
a record $59.3 trillion.
To put that in perspective for you, that is roughly double the entire GDP of the United States.
It's an astronomical number. It reinforces their systemic importance. And that sheer size is a massive economic moat. It's a natural inflation hedge because as global asset values grow, BNY's fee base just grows right along with it.
Okay, now let's move to market and wealth services. You called this the high-margin crown jewel.
It really is. Revenue up 8%, but the profitability is spectacular. A 49% pre-tax margin.
Almost 50 cents of every dollar in revenue is pre-tax profit.
And that's driven by their high-value platforms like clearance and collateral management and payments. In a high-rate world, everyone needs to optimize their cash and collateral. BNY provides the essential infrastructure for that, and they charge a premium for it.
But then, we hit the laggard, investment and wealth management.
A much different story. Revenue was down 2%, and the pre-tax margin was a meager 17%.
The contrast between 49% and 17% is just jarring.
It is. And this is a classic symptom of the headwinds hitting active asset management across the board. Investment management revenue fell 4%, even while their assets under management increased by 7%.
How does that happen?
That divergence is the classic sign of fee compression. People are shifting to lower-fee passive products, and BNY noted they had cumulative net outflows from their active funds.
So the key takeaway here is that BNY's value is in its high-margin infrastructure, not its traditional asset manager.
Exactly. That investment management arm, with its 17% margin, is structurally dilutive to the rest of the bank's incredible profitability.
All right, let's talk financial strength. For a bank this important, a GSIB, capital is everything. Did they maintain that fortress balance sheet?
They absolutely did. Their highest quality capital buffer, the CET1 ratio, improved significantly to 11.9%.
And why is that 11.9% number important for the listener?
It shows really strong organic capital generation. It means they're earning so much money so efficiently, with that 26% ROTCE, that they are strengthening their capital cushion even while returning huge amounts to shareholders.
And speaking of that, BNY is an absolute cash cow.
They return a total of $5.0 billion in capital for the full year 2025.
Broken down into?
It was about $1.4 billion in dividends and a huge $3.5 billion in share buybacks.
So if you do the math, they essentially handed 94 cents of every dollar they earned right back to the owners of the company, a 94% payout ratio.
It highlights the power of that custody business model. It just doesn't require a lot of capital to run, so it spits off tons of free cash flow.
Now, this brings us full circle to the road ahead. This is the future outlook that spooked the market.
Right. The 2026 strategy pivots from transformation to a new focus on growth, which they're calling raising the bar.
And they've set some ambitious new targets.
Very ambitious. They raised the pre-tax margin target to 38% and the ROTCE target to 28%. These are truly best-in-class metrics. They believe their efficiency journey is far from over.
And a central piece of achieving that is their investment in artificial intelligence.
This is the strategic differentiator they're banking on. BNY talked about its internal Eliza AI platform and noted they have 160 enterprise AI solutions actively running in production.
And this isn't just marketing fluff. We're talking tangible cost reduction.
Absolutely. The goal is unit cost reduction. They already reported that operations unit costs were down a stunning 24% in 2025.
24%.
That's the real money saver, automating things like compliance checks, payments processing, reconciliations.
Yet we are still stuck with that 2026 guidance that caused the hesitation. The 5% revenue growth and 3-4% expense growth.
And that's the core disconnect. That guidance implies positive operating leverage of only about 150 basis points.
A huge slowdown from the 411 they just delivered.
Exactly. The market is basically saying, if you're guiding to 3-4% expense growth, we don't really believe you can hit that 38% margin target.
So let's synthesize this. What are the two most important takeaways for you from this whole deep dive?
Okay, first, the transformation under Robin Venemet was a roaring success. BNY is now a highly efficient cash-generating machine. That 26% ROTCE proves it. It's a quality institution.
But second, the stock dipped because the market had already priced in that quality. It demanded acceleration, and the forward guidance, while healthy, signaled a slowing in the pace of that margin expansion.
The investment thesis is really clear now. BNY is a quality and yield holding. It is not a high-growth tech stock. Future returns are likely coming from compounding dividends and buybacks, plus that steady, modest growth.
And you mentioned AI as the wild card. Let's leave our listeners with that thought.
Right. The bank is targeting a 38% pre-tax margin, but that's based on that conservative 3-4% expense guidance.
Okay.
But what if? What if the widespread deployment of their 160 AI solutions, like Eliza, causes deeper and faster unit cost reductions than they're currently projecting?
What if expense growth comes in closer to, say, 0 or 1%, not 3 or 4?
Could BNY's efficiency gains significantly outpace their own conservative guidance? If that AI dividend pays off bigger and quicker in 2026, that 38% margin target could actually be a significant underestimate.
And that would potentially unlock massive new shareholder value.
That's the strategic pivot to watch, and that is the moment the market will stop saying, "Sell the news."